Welcome to How to Win the Retirement Game. Thank you so much for joining us today. I am Sam Clear, and I've been in the financial services industry since 2003. Since that time, myself and my team have helped thousands of people to prepare for retirement, protect their loved ones, and win or either get on the right track to winning their own personal retirement game. So I chose to put a picture up from about the time when I first got going, and this is an old picture of myself and my young family at the time. Since here, I have lost a lot of hair and I've found a lot of weight. So that baby in the picture right there, my oldest, she's actually a junior in high school now. And since that time, we've also had another child. My wife and I, we've been married nearly 20 years. Our youngest actually just turned 14 a couple days ago. So to get into this discussion, I would like to tell you all how I ended up here today recording this webinar. Now, I've learned a lot of things since I began in my career in 2003. And one of the early licenses that I received, so the first license that I got was a life insurance license. Then I learned that there was a securities license, and I wanted to go get that one as well. So in order to be able to offer individual stocks, you have to get what's called a Series 7. And to offer bundled securities like mutual funds and variable annuities, you need to get the Series 6 and 63. And in order to take either of those exams, you have to have a sponsor. So it's almost impossible for me to locate a sponsor at that time for the Series 7, which is the one that I actually wanted to get. But I found a company called Foresters that was willing to sponsor me for the Series 6 and 63. While I was in the class for the Series 6, I learned something that would change my professional life forever. So before I get into what I learned in class, let's briefly discuss the differences between hedge funds and mutual funds. So if you Google what's the difference between a hedge fund and a mutual fund, here's what you'll see. Mutual funds are regulated investment products offered to the public and available for daily trading. Hedge funds are private investment products that are available only to accredited investors. And hedge funds are known for using higher risk investments that with the goal of achieving higher returns for their investors. And this is all from Investopedia. So I don't know about you, but that's not really telling me what the difference is. So let's break it down even further so you can really get an understanding of what the difference between the two of them are. So the first thing that it tells us about the mutual funds is that they're regulated, which means that there are rules that go along with them, which is why I had to be licensed to offer them. And it says that they're offered to the public. So anyone can buy them since they are offered to the public. If you have a 401k, chances are you own mutual funds and may not even realize it. The Employee Retirement Income Securities Act of 1974, which is also known as ERISA for short, has rules on what can and cannot be used for retirement accounts. And since its inception in 1980, 401ks have been managed by mutual fund companies. So if you were to look at one of your 401k statements, your plan administrator is never going to be your employer. It's going to be a company like Fidelity or Schwab, Vanguard, or someone else like that. So just about every adult in America owns mutual funds today. Now let's talk about the hedge funds. So Investopedia didn't say that they were unregulated, but it told us that the mutual funds were regulated. And it didn't say the same thing about the hedge funds. And that's what lets us know that they have very little to no regulation. So we were also told that they take higher risk, which gives them higher returns. And last but certainly not least, that they are private investments only offered to accredited investors. So if you're anything like me, the first thing that I wanted to know was, how does one go about becoming an accredited investor? Do you need an advanced degree in economics or finance, or maybe a securities license like the Series 6 or 63, which I was studying for? No, none of these will make you an accredited investor. Here's what an accredited investor is. If you would like to verify, feel free to go to finra.org and check it out for yourself. Now, FINRA stands for Financial Industry Regulatory Authority, and they handle all of the licensing and regulation of broker-dealers, which was a class that I started out talking about. So this is how one becomes an accredited investor. It says, Regulation D investments are generally only available to accredited investors. For most investors, this means that you have to have a net worth that exceeds $1 million, which does not include your house, or you have to have income that's $200,000 or higher for an individual for each of the last 2 years. Or if you're married filing jointly, you have to yourself and your spouse have to have over a $300,000 income, again, for each of the last 2 years. So the picture next to that $1 million gives the whole thing away. To be an accredited investor, you need a big bag of money. Now, remember on the last slide when we talked about those high risk, high reward investments? Here's what we're talking about. So what can a hedge fund do that a mutual fund cannot? So hedge fund managers have the ability to use high risk tactics, such as short selling stocks and taking speculative positions in derivative securities. Mutual funds cannot take such highly leveraged positions, making them less risky, but also limiting their potential returns. And this is from syndicatorroom.com. So I'm not going to talk about these speculative positions in derivative securities, but if you would like to learn more about how hedge funds use those, watch the movie The Big Short. I'm sure a lot of you have probably seen that movie already, but that deals with that whole thing. And that was really eye-opening too. So if you haven't had a chance to, I definitely recommend you checking that movie out. But the way this is worded, the average person would say that mutual funds sound a lot better for the public because it's less risky. But trust me, when you really understand what all of this is and you'll see which one is really less risky. So here's what I learned in class for my securities license that changed my professional life forever. At that time, it was actually illegal for a mutual fund to short sell a stock. And that was one of the things that I learned in class. So since then, the laws have changed and it's no longer illegal, but it's still highly frowned upon and it's rarely done. So if you're not familiar with what a short sale is, here's what it is. Before this day in class, I had never heard about this before. And here's how the teacher explained it. She gave a real life example of one that she did back in the 80s. I don't remember the entire story, but here's the gist of it. She said that some airline had a huge crash where lots of people died. And she read an article in the newspaper that morning, which said that after an investigation, the cause of the crash was a mechanical issue that could have been avoided with proper maintenance. So after reading this article, she said that she called her broker and asked where the stock was of this particular airline where it was trading at that particular morning. So for the sake of the story, let's say that it was $50 per share. Now, she said that she told him to sell her 1,000 shares on margin. So margin is credit, if you're not familiar with that term. So she actually sold 1,000 shares that she did not own. She says that she's watching the ticker and the stock is plummeting all day. She says about 3:30 in the afternoon, she calls the broker and asks where those shares are. And she actually says that she told him even before that to buy those 1,000 shares back. And then she said, what's the current price? And it was, let's say it was about $20. So to sum it up, a short sale is when you sell high first and then buy low later. So she actually made $30,000 in one day selling shares that she did not own at a higher price and then buying them back at that lower price. She literally created $30,000 out of thin air from her understanding of how to play the game. I thought that this was the most fascinating thing that I'd ever heard in my life. Then I thought, why would I ever buy or sell mutual funds if the regulation that's in place requires me as a member of the public to lose my money when things like what happened with that airline happened while private accredited investors are literally creating money out of thin air from the same event. So after learning this, I knew that I would never sell any mutual funds, and I understood right there in that class that the game is fixed. And even though the regulation is designed to make the mutual funds less risky, the everyday people like the teachers and the firefighters are the ones taking all the risk, while the millionaires are literally transferring money from their 401ks over to their hedge funds every time that the market crashes. Would you like to see an example of the fix in action? I can't hear you, so I'll assume that you said yes. So take a look at this article from the Wall Street Journal. This is from November of 2019. It says here that the world's largest hedge fund takes a big bearish trade. They did a $1.5 billion short sale with options, which allows for them to which allows for even greater profits. And they bet that stock markets around the world would fall by March. Now, they are the world's largest hedge fund. So what do you think happened when the second largest and the third largest and et cetera, found out about the bet that the biggest hedge fund company made? Well, of course, they made the same bet. So if all the hedge funds are selling all stocks from all over the world in March, what do you think will happen? Well, we don't have to guess. Let's just take a look. This is a stock chart from the last year, from November of 2019 to November of 2020. And if you see here, it looks like a roller coaster. The stocks are doing really good. And then look what happens in March. They dip all the way down from about 30,000 to about 20,000, or almost 10,000 points from February to March. Then they go back up. So if you can see here, these hedge funds actually cause the stock market to crash. And it's just simple supply and demand cause and effect economics. If everyone is selling something, prices are going to go down. If everyone is buying, prices are going to go up. So it's just like if a person had a lemonade stand. If you were a kid, or if you had a kid that offered lemonade, and let's say that 5 other kids on the same block decided they were all going to have a lemonade stand right next to each other. Well, eventually what would have to happen, because of all the people selling lemonade on the block, in order to compete and to sell theirs faster, some of the kids are going to start lowering their prices. And as the time goes by, the prices are going to go lower and lower and lower and lower until they just stop selling lemonade. So the same thing happens with the stock market. We talked about all these big hedge fund companies selling all of these stocks, and they did this months in advance back in November, and they did it for March. So when they were all selling all of those stocks at the same time, it forced the stock market to go down because they were all selling. And guess what? After that, they bought them right back, and they just created, again, money out of thin air. They actually orchestrated the whole thing. So I'm reminded of a lesson that I learned from a mentor years ago about how money is never really lost, but it's just lost to you. He told me about how he taught this lesson to his 2 daughters with the old stuffed animal claw machine. So years ago, his daughters both asked for 50 cents to get a teddy bear from the machine. He gave them both the money and waited for them both to try their luck for the prize. Of course, they both ended their turns without winning the teddy bear. After they were both finished, he asked where the money went. They both agreed that the money was gone. He shook the machine and asked if they heard all the change inside. They both said yes, so he went on to teach them that every so often, the owner of the machine comes by and collects all the money. So the money is still there. It just does not belong to them anymore. So again, money is never lost. It's just lost to you. They got the lesson, and I hope that you do too. The people who really understand how to play the stock market game come by every so often, and they collect money from those who don't even realize that they're a part of the game. When the stock market crashes, money is never lost. That money is not gone any more than the change in that claw machine. It was collected by the accredited investors. The information that I've shared with you so far about the fixed nature of the money game was not intended to make you angry. Hopefully, this knowledge empowers you and gives you the determination to take control of your personal financial situation. So now that you see the game for what it is, you can participate and play it at a higher level. So now we have come to the part for me to give you the rules to the game. Do your best to master these fundamentals. They would allow you to reach your personal goals. So rule number 1, the first rule of the retirement or money game, even for that matter, is to pay yourself first. And this goes without saying, because if you don't pay yourself first or set some of your money aside, you won't have any money to invest. You won't even have any money to put in the stock market or anywhere else for that matter. Now, I'm sure you probably heard this saying before. Most people have, but very few people know where it came from. This saying actually comes from a book called The Richest Man in Babylon. And it's an old story. It's a great story. If you haven't read it, I definitely recommend it. In this story, the richest man in Babylon is telling his friends how he got to be that way. And he starts the story by telling about how he met when he was a young man, he met the man who at that time was the richest man in Babylon. And he had did some work for him. And he told him that if he would give him the secret to becoming rich, he would do this work for free and get it done quicker than he ever could any other time. So when he first was told these simple 3 words, pay yourself first, he thought that he was being cheated. But the rich man told him, I assure you, this is the secret to my success. And he told him that he should put up at least 10% of his income. So again, that's the first rule to winning the retirement game. You have to put up a nice portion of your income, at least 10%. And if you can afford to do more, you definitely want to do more. The second rule to having a successful retirement or nest egg for that matter is minimizing your risk and losses. So we just talked about how the stock market is fixed and how those who really understand how the game is played don't take those losses. Now, a lot of times you'll hear so-called experts on TV telling you to just buy mutual funds and hold them because in the long run, they always go up. Well, if you're a savvy investor, that's not what you do. As we saw, those accredited investors who have enough money, that's not what they're doing. They're making money when the stock market is going down. So if you don't have enough money to invest in a hedge fund, you definitely want to do all that you can to minimize your risk and losses. In fact, you want to try to eliminate them if you can. And we'll talk some more about some different strategies that can help you do that as well as we move along. The third thing you want to do is take advantage of tax qualified retirement vehicles. Now, if you're at a company that offers a 401k, that's an example of one of those. And what we mean by qualified is you get advantages of participating in these plans. You get tax advantages with the 401k now, all the money that you put in there. Let's say you did that 10% we were talking about. It reduces your income by 10%. So if you make $50,000 and you're putting in 10%, $5,000 would go into your 401k, and you would only pay tax on $45,000. So it reduces your taxable income now. There are other programs as well that even have some additional tax qualifications, which can help you out on the back end, and you can actually get some tax-free money. We'll talk some more about that one as well a little bit later too. The fourth thing that you want to do is set specific and realistic retirement goals for yourself. Now, what do we mean by specific and realistic? So you don't want to say something generic like, oh, I just want to have a lot of money or enough money to live comfortable, because that's not really a goal. That's very vague, and you're not really aiming at something in particular. You want to have either a specific dollar amount that you plan on reaching, or you want to say that I would like to be able to maintain, say, 70 or 80% of my last working year's income. That's a specific goal. And when we say realistic, if you are, getting closer to retirement age and you haven't started doing anything, it's not realistic to believe that you're going to be able to save $1 million and you plan on retiring in the next 5 years. So again, you want to set specific goals and you want to make sure that they're realistic for your personal situation. And the fifth and final rule is to make a game plan and stick to that plan. So again, it's hard to reach any goal if you don't have a plan. So you definitely want to figure out what it is you're shooting for, and then you want to make a plan. And once you make that plan, you want to do your best to stick with it. So over the years, I've seen just about every type of retirement situation that there is out there. I've seen people with well over $1 million in retirement accounts, and I've seen people who decided not to save anything, and they were perfectly fine with that because they plan on just working until they couldn't work anymore. Now, there's nothing wrong with anyone's personal situation. It's just where they are now, and anyone can make a change at any time. If you've been struggling, it's probably because no one has ever taken the time to educate you on how the retirement game is played and how to win a retirement game. So how can you be expected to know all the ins and outs about the stock market, different types of retirement accounts, or even how much you should be putting up? They don't teach us about retirement in school. They don't even teach us about how money works when you go to school, if you really think about it. Everyone says study hard, get good grades, get a good job, and put some money up and for your future, and eventually everything is going to work out. But most of the so-called experts tell us to put all our money in a market and hope that everything works out in the long run. Just buy and hold, and you'll always win eventually. This is just not true. That's the hard way, the risky way, the way that people do it when they are not aware of all the options. Putting your entire retirement account in the market and leaving it there is like taking your entire paycheck to Vegas and making a bet with your whole check at one time. Now, you may win big, but chances are eventually you're going to lose. Earlier, we saw a stock market chart, and it literally looked like a roller coaster track. It peaked, then dropped 10,000 points in March. Now it's about back to where it was, and we can say with 100% certainty that eventually it's going to go down again. There has to be a better way to save for retirement. What are the secrets to retirement success? Well, here are 3 secrets that will help you win big in the retirement game that most people don't know. Secret number 1, minimize or eliminate risk. This is actually one of the fundamentals as well. So as we said earlier, the stock market is a great place to grow your asset, but it has a huge intrinsic risk element built right into it. There are other ways to grow your money with little to no risk. Secret number 2 is to minimize or eliminate future taxes. So the 401k and traditional IRA are some of the best ways to grow your assets and give you a tax break now. But these instruments can create a tax time bomb in your future. Secret number 3 is to regularly review your personal strategy with an expert. So are you on track to reach your personal retirement goals? Are you saving enough of your retirement plan to last for your retirement life? Well, there are a lot of other questions like these that you can get answered if you take advantage of reviewing your personal retirement strategy regularly with an expert. So secret number one, there are three main institutions where you can set up a retirement account. The first is a bank. Now, banks are FDIC insured, which means that your balances are guaranteed even if that bank was to go out of business. Banks offer the most safety and the least interest. The bank is in business to lend out your money on interest and to keep majority of the profits for themselves. The second institution are brokerage houses. These institutions offer no guarantees, but they have the greatest upside potential. If you decide to put all your money here, you will have to hope that it won't be harvested by the hedge funds as you get closer and closer to your retirement age. What if there was an institution that offered the guarantees of banks and the upsides of the market? Well, there are institutions like that, and you use them already. You just never thought about using them for your retirement savings. The third institution where you can set up a retirement account would be an insurance company. Insurance companies are a cross between the other two. They offer similar straight fixed accounts like the bank, but with rates as much as 400 times higher than what the current rates are on savings accounts right now. And they also offer variable accounts that work exactly the same as mutual funds. The insurance companies are not FDIC covered, but they are covered by individual state-by-state guarantee associations that work the exact same way as FDIC. In fact, that I in FDIC actually stands for insurance, because insurance is all about protection and the transference of risk from you to the insurance company. Insurance companies actually offer a hybrid account that is the best of both worlds. It's called a fixed index annuity. And here's how it works. So let's say that you started with $100,000 20 years ago. Let's say it was back in 1998. And you had the choice between putting that money directly in the stock market, which is that red line, or you could use this vehicle that I'm telling you about now, which is called a fixed index annuity. Well, in the short term, if you look at those first couple of years, the actual person who put their money in a market is way outperforming the person with the fixed index annuity. They shot all the way up to $151,000 by the time we get to the year 2000. But we all know what happened in 2001. Even in the year 2000, we had the .com, and then we had September 11th in 2001. So as you can see, the next 3 years in the stock market, those next three dots are all down. But look what happens to the fixed index annuity. It stays flat for those 3 years. So this is the concept. What it does is it allows you to participate with the upsides of the market up to a certain percentage. So as you saw, when the market was at 151, you didn't get all those gains. You were only at 124. So what it does, you're trading off some of your upside potential. So it caps you, or you pay a spread, either one. We could talk about the specifics later if you decide to take advantage of learning about some of these options. But when the market goes down, this is where you win. You stay flat. So that 124 can never go below 124. Once you reach a level, that becomes your floor. So what happened over those next 3 years is you stayed flat. But look what happens when the market turns back around. This person got all the way down to $90,000. When they started with 100, went up to 151, and now they're all the way down to $90,000. So back in 2008, they got right back to where they were in those first 2 years, back up to 151. But because you didn't take those down rides, you were over $10,000 ahead of them. And then we all know what happened in 2008, another big stock market crash. Again, they went all the way back down to 93,000 from that 151. Well, again, that 162 is now your floor. You can never go below that. So the same thing happens. The market turns back around as it does. And all the years when it's down, you stay flat. That becomes your new floor. And then you go up every time the market goes up. So when you get to the end in 2018, over here, this person is at 287.60, while the person in the market is at 257. So again, this is a great concept that I've learned about, that we've helped a lot of people to, again, take advantage of the upsides of the market, but protecting themselves every time the market goes down. Another thing that most people don't know how to do is to minimize or eliminate future taxes on income from retirement accounts. So one of the questions that I always ask clients at our one-on-one appointments is, do you think taxes in general will be higher or lower by the time that you reach retirement age? No one has a crystal ball and can say for sure either way, but most people think that taxes in general will be higher over time. One of the things that you have to keep in mind about money in your 401k is that that money has never been taxed. So if you have 250,000 in your 401k, you don't actually have the full 250,000 because Uncle Sam has not gotten his cut yet. Let's say that taxes on that 250,000 will be about 30%. By the time you reach your retirement age, $90,000 will be due in taxes on that 250. So in actuality, you have $160,000, and there is no way to get around it. Let's say you don't need that 250,000. You plan on leaving it as an inheritance for future generations. It's your money, and you definitely have the right to do that. However, you will still be forced to pay tax on that money, and that's what's called a required minimum distribution, or RMD for short. The way that RMDs work is this. Let's say your required minimum distribution is $25,000 on that 250. So what will happen is you will get a letter from the IRS that says something to the effect of, congratulations on reaching age 70 and a half. That's the age that RMDs are set to begin. This year, your required minimum distribution is $25,000. Do you think you can call up the IRS and say, I choose not to take my RMD, so you guys are just out of luck? Of course that wouldn't work. If you decide not to take your RMD, then you are given a tax penalty of 50% of whatever your RMD was supposed to be in that year. So in that illustration, you would be on the hook for a $12,500 tax penalty. Now, why do you think RMDs are there? Do you think the IRS wants you to take your cash out and enjoy your old age and travel around and enjoy your money? We all know they care less about that. The reason why your 401k has RMDs built into it is because it is a tax deferred program. It also came out of your check pre-tax or tax preferred. So deferral just means you're putting it off to a later date. Imagine what would happen if you deferred washing your dishes. One day, eventually, one day you're going to need some dishes. So they're going to pile up, and eventually you're going to have to wash the dishes because every dish in the house is dirty. Well, the same thing happens when you defer your taxes with your retirement account. That tax bill piles up, and if you are like me and believe that taxes are going to be higher in the future, you have created what's known in the financial service industry as the tax time bomb. A big chunk of your retirement money is earmarked for the government. We could call it a 401g or 403g because majority of, if not all of your stock market earnings are going to go to the government in the form of future taxes. So is there any way to eliminate this tax time bomb? Absolutely. You've probably already heard of it. It's called the Roth IRA. In the same scenario from earlier, if you had $250,000 in your Roth IRA and wanted to leave it as an inheritance to future generations, you absolutely could. There are no RMDs with the Roth IRA, and the reason why is because the money in the Roth was taxed before it went into the account. So that's the difference. There's no way to avoid taxes completely, but if your bet is that the taxes are going to go up over time, the Roth IRA is likely the best way to go. Oftentimes, people may not recognize how great the Roth is when they hear that they have to pay their taxes up front. But here's why the Roth IRA is such a winner. All of your earnings or the interest that your money makes over time will never be taxed so long as you follow the rules. And here are the rules. Your account must be open for a minimum of 5 years, and you must be at least 59 and a half before you start taking distributions. That's it. As long as you follow those rules, all of your money is going to be tax-free when you take it on the back end. If you would like to learn all of the details about how Roth IRAs work and see if it will be a fit for your retirement strategy, one of our licensed representatives would love the opportunity to give you all of the details. This brings us to our third and final secret of retirement success, and that is regularly reviewing your personal strategy with an expert to make sure that you're on track to reach your personal retirement goals. I mentioned earlier that I have been doing this for close to 2 decades. Do you know what the number one thing that I hear from clients when I do one-on-one consultations is? Where were you guys 25 or 30 years ago when I just got started out? I wish that I could have learned this information then. I would be so much further ahead by now. I'm not sure where you are in your retirement journey, but I am a firm believer that everything comes into our lives right when it is supposed to. If you are not working with a financial expert now, we will love the opportunity to apply for the job. Most people never get an opportunity to sit with an expert and map out a strategy that will lead them to the results of their own choosing. The way that most people prepare for retirement is by choosing a dollar amount per pay period or percentage of their income when they start working, and they rarely revisit it again. Well, are you saving enough to reach your personal retirement goals? Do you know what dollar amount in your retirement account will allow you to have a comfortable retirement for the rest of your life? Based on what you already have accumulated, are you putting up enough to reach your specific goals? I could ask 20 more questions like this, but I think you see the value of getting expert advice for your retirement planning. Most people have no idea where they currently stand, and even less of an idea about putting together a game plan to reach their specific goals. So if you've been told that in order to make money, you need to take huge risks in the stock market, it's not your fault that you were forced into a game that is fixed with no advice on how to win that game. So here's what we're going to do. This is one of the most important steps of all. Imagine what would happen to a ship that was just turned on and let go. There is no way for a ship like that to reach a port safely. It would either sink or crash into some rocks or on a shore. You have to have a goal and a target to aim for. Your goals are totally up to you, and no goal is too big or too small. Do you want a certain dollar amount for retirement? To have a certain percentage of your current income still coming in? Pause this recording right now and decide what a successful retirement means to you and write it down. Now that you've decided what a successful retirement means to you, let's see if you are on the right track to reach your personal retirement goals. The best way to do this is to take a personal inventory of all of the resources that you currently have available to you for retirement. These would include any pensions, 401ks from current or previous jobs, CDs, savings bonds, or any accounts that you have set aside for long-term savings. If you are banking on Social Security, it's always best to do a low estimate for that, since the Social Security Trust Fund will run out of money by 2035. The last, but certainly not the least of these three steps, is to schedule your complimentary retirement analysis. This is actually the most important step in the process, as the retirement analysis is the tool that we use to make sure that everything you decided would make your retirement success becomes your retirement reality. Let me ask you a question. If we could show you how to win your own personal retirement game, how to thrive in retirement and not just survive, would that be worth 15 minutes of your time? Our phone call will consist of you getting to know a little bit more about us and us getting to know a little bit more about you. After finding out about your specific retirement goals and personal inventory, we will prepare you a custom retirement gap analysis report. This is an expert report, and here are just a few pages. This report will tell you everything that you will ever need to know about your personal retirement situation. We can project any pensions, Social Security, what your 401k or 403b will look like with your current strategy, any shortfalls, solutions for those shortfalls, and much, much, much more. By scheduling a call and receiving your own custom retirement gap analysis, here's what you'll be able to eliminate: uncertainty, stock market risk, future taxes, fear of the future, and so much more. Don't worry, there is no cost to meet with one of our experts, and we do not charge fees for any of our services. We are compensated by the companies that we represent for bringing them new business. If there are any needs that arise as we review your current retirement situation, we will make recommendations about programs that could potentially fill any gaps in your retirement plan. If it makes sense to you, great. It becomes a win-win situation. If you decide that our recommendations will not work for you, that's totally fine too. There is no pressure to do anything that you do not think is in your best interest. If all we did on this phone call was finally give you an actual snapshot of where you stand today, would it be worth it? If all we did on this call was to help you learn about strategies that can eliminate stock market risk and future taxes, would it be worth it? If all we did was give you access to expert personalized reports that some people pay upwards of $1,800 for, would it be worth it? I think that it would be. All of these great benefits are totally worth it, worth you setting aside 20 minutes for a phone call. So you have two choices. Option one, don't do anything different. Continue on your current path and hope that everything works out to your advantage in the long run. Option two, Schedule a free, no obligation call with one of our experts to know exactly where you stand and get a personalized plan to reach your specific retirement goals. Remember, some have paid upwards of $1,800 for the exact report that we are offering to you absolutely free. So click on the calendar below to schedule your call today. We look forward to hearing from you.